Hello, people. I hope you're all doing well. So, this is going to be our first lectures, our first lessons on liquidity engineering, or engineering liquidity, which is simply the strategy that I trade. And it's a very simple strategy. It's a very simple strategy. First of all you need to do, or all you need is to really understand market structure well. So you need to have basic knowledge of market structure. Basic knowledge of market structure. Know how to use the FIB tool as the Fibonacci tool. How to use the FIB tool. And I think this is basically the most important things you need to know. Okay, so with market structure, we know from the Dow theory. The Dow theory, it says an uptrend. So let's just see an uptrend. An uptrend is in a way like this. We have low, then a high, a lower what? A lower high, a higher high, a lower high, a higher high, a lower high, a higher high. So this is how the uptrend is according to Dow theory. Oh, what is this? According to the Dow theory. And then with a downtrend, we simply have it in this form. We have a high, then a lower high, a lower low, lower high, lower low, lower high, lower low, lower high, and a lower low. Why do price consistently keep moving in this direction? Price moves in an uptrend or a downtrend in search of what? Liquidity. And liquidity is essentially the ability of an asset to be traded without causing a significant degree in price change. And we also have the third market structure, which forms, many people call it the accumulation. We have a highs and then lows, so we have consistent moves like this. And here, what the market always do is that it will take out the low or the high, come and retest the 50% retracement level, and then it will begin moving in the assumed direction. Okay, so let's talk about the first model of L.E. First L.E model, and in this lesson we're only going to talk about the first one. In the other lesson we talk about second, third, and then the fourth. So with the first L.E model, it's essentially like this. We have a low, and then we have, whoa, what is wrong? We have a low, and then we have a high. So price will form a retracement. You will have a break of structure. So what we want the market to do, or what we expect from the market, is that we want to see price coming out to take out this low, and then it will continue with the direction, whether it's in this case this is an uptrend. So here this low is our A level, and this strategy or this model is known as the ABC. This is B. B is the structural liquidity or the inducements, and then we have a turning point, which is C. But actually we have two turning points associated with this one. So here we have the first turning point, we can say is T1. You see, this is a turning point because price reversed down, and then B itself is also a turning point. That's the structural liquidity before the break of structure happened. And then we have C, which is the second turning point. In the case of an uptrend here, I'm considering the ones up here. This would be the second one, and then price comes, take out the structural liquidity, and then it will move in this direction. So this is the first L.E model, which is known as the ABC, which is known as the ABC. Okay, so this is that for an uptrend. For an uptrend, just like this. That's exactly what I've drawn up there. And then for a downtrend, for a downtrend, we will have it like this. So we have the A level here, price will move down, we have a retracement, have a break of structure. We expect the market to come and take out the structural liquidity or the B level, and then it will continue with the swing direction or with the original trend. So here, this is our A, as I said. This becomes our A level. This becomes our B, and then here, this becomes our second turning point, moving downwards. This is our second turning point. This is our first one. So that's essentially the first L.E model. But how do we find a highly probable trace or highly precision trace using the first L.E model? So first of all, we have, this is our A level, and this is also our A level here. This is our B, this is our B in the case of an uptrend and then downtrend. So let's look at some examples. First of all, our A level must be around or in confluence with supply and demand levels, support and resistance levels or areas, anyhow you want to call it. We have QMR zones, and then we have sweeps. So it sweeps of higher time frame highs or lows. So essentially, for both uptrend and downtrend, a highly probable L.E trade must be in confluence with any of these levels, zones, or areas on the market. So first of all, how do we find a highly probable trade of L.E using supply and then demand levels? So this is how it is. We want to have a move like this, so a big move to the upside, and then price will sell down again, another big move to the upside, and then here when price is coming, we expect it to form the L.E model. So here we will have it like this, and then like this. We expect price to take out the structural liquidity and then continue the move. So in this case, the A level, this is our A level. Holy shit, having some little difficulty, sorry. Okay, so this is our A level, which is the low in this case. It is in confluence with these two demand levels. So we have this one and then we have this one. So this makes it a very, very, very highly precision trade. You have a high chance of always taking a winning trade using this setup. So let's talk about the one with we have support and resistance. Well, how did I spell that? Okay, you already know what to do. So with an uptrend, the move to the upside like this, we want a level of resistance. A level of resistance, and at least if you get two moves to the upside, two retest is okay, or three retest makes it very strong resistive area, unlike a single resistance level. So here price will come, it will test this resistive area, it will form a structural liquidity, it will come and take out the B level, and then it will continue with the trend, and then it will continue with the trend. So let me enlarge this one for your okay. So this is with support and resistance. With support and resistance, this is how you use the first L.E model to find highly precision or highly probable trades. Then let's talk about the one with what? The QMR zones. QMR zones. So QMR is like this. We have a long trend coming, price will take out the low, and price will go up, it will come to this zone. So here this becomes this one here, this area here is a QMR. This move, we have sharp move down, a retracement, price takes out the low, it closes above, a rally to the upside. So here you want to see price forming the same L.E model. So like this, price will take out the B level, and then the move will continue to the upside. Yes, so here it is in confluence with what? This QMR zone. This QMR zone, it is in confluence with the QMR zone. So this makes it a highly probable trade. And then same for this one, very strong trade. Always will end up taking what? A winning trade. And then we have sweeps of higher time frame highs or lows. Higher time frame highs or lows. I don't want to make this a very long video. I will continue with examples, show you examples from 2024 up to 2026 of this model, and some of the losses I've taken and why the losses happens. Yeah. Okay, so sweeps of higher time frame highs or lows. So let's say on a higher time frame, price has been moving. We have this. So when a high, so in this case, let's say a low was taken, we want to take a long trade. So a low is taken. The low was taken. We want to expect the market to print the first L.E model, and then we can take a long trade. We can take a long trade. So this one is basically used to trade reversals, and with this you can get a risk to reward of an average of 1:3 up to 1:2. It has a very high risk to reward, 1:10, 1:20, depending on your patience and how long you can hold the trade. Okay, so thank you all. I'll continue with examples on the next video.